Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Irrespective of the market movement, many Adani Group stocks have fetched stellar returns this year. In fact, a couple of the Adani Group stocks have gained 300 to 400% gains in just the last few months. One of them is Adani Power. The stock is so popular that investors seem to be chasing it at any and every valuation, no matter where the markets are headed. The logic provided for the huge run-up in the stock is the massive demand for power as in electricity in India in the coming decade. Now, if that is the case, the question arises, why should other power stocks like say NTPC not enjoy the same kind of valuations? More so, does Adani Power even deserve the kind of valuations it is fetching currently, which is at least 2 times NTPC's? Hi, I'm Tanushree Banerjee, editor of Equitymaster's blue chip recommendation service Stock Select. Welcome to Safe Stocks, where we discuss ideas to create and preserve wealth in the safest stocks. If you haven't subscribed to the Equitymaster YouTube channel yet, please do so and click on the bell icon to get notifications for my latest videos. Now, before we delve into the numbers and valuations, let us look at the basic differences in the business models of the two companies, Adani Power and NTPC. Adani Power, a part of the diversified Adani Group, is the largest private thermal power producer in India. The company, along with its subsidiaries, sells power under a combination of long-term power purchase agreements, short-term power purchase agreements, and on a merchant basis. The company has an installed thermal power capacity of 13,650 megawatts spread across 6 power plants in Gujarat, Maharashtra, Karnataka, Rajasthan, Madhya Pradesh, Chhattisgarh. It also has a 40 megawatt solar power plant in Gujarat. The company accounted for 5% of India's total thermal power generation and 15% of all private sector power generated as of March 2022. Adani Power is also constructing a 1600 megawatt ultra supercritical thermal power plant in Jharkhand, which will export power from India to Bangladesh in the coming financial year. The company's capacity utilization, which is also called the plant load factor (PLF), was just 52% in the recent financial year FY22 compared to 59% in FY21. NTPC, meanwhile, is primarily involved in generation and sale of bulk power to state power utilities. It's a PSU after all. It also has other businesses like providing consultancy, project management and supervision, energy trading, oil and gas exploration, and coal mining. The company's power capacity stands at 63,000 megawatts from 70 power plants. Out of total capacity, 83% comes from coal plants, followed by gas, hydro, and renewables, which are about 5 to 10%. NTPC owns 17% of the total installed capacity in India, with 22% or 1/5 of the electricity generated of the country. NTPC also has 20,500 megawatt of power projects under construction. Presently, 76% of under construction projects are from coal, followed by hydro, which is about 13%, renewable energy, which is wind and solar, at about 11%. Importantly, NTPC wants to expand its power capacity from 63 gigawatts to 130 gigawatts by 2032. It also aims to increase its concentration of non-fossil fuel assets from 7% of capacity to 30% of capacity by 2032. Not just that, the company has been operating at a much higher utilization rate compared to any other power company over the past 5 years. It achieved PLF, which is the utilization rate, of 60 to 68% during these years. What is most important to note is that the leverage, which is the debt to equity ratio of Adani, as in Adani Power, is about 12 times compared to NTPC's 1.5 times. Now, how do you decide whether the stock of Adani Power deserves the valuations that are 2 times NTPC's or not? Well, we often look at the shareholder returns being generated by the companies to decide their valuation multiples, which is the return on equity. But in the case of a business with significant leverage, this would not make sense as the debt keeps the return on equity artificially bloated. So what you could do is follow what I call the CULT framework to evaluate asset-heavy businesses with leverage. What does CULT stand for? It stands for capacity, utilization, leverage and track record. What this will do is that it will help you understand the kind of capex the company has taken or is yet to take to become competent. How well is it sweating its assets with the utilization rates? Can its balance sheet accommodate more debt? And importantly, if the management of the company has demonstrated a track record of good execution and shareholder wealth creation in the past. So, looking at the CULT framework of Adani Power and NTPC, would you want to bet your money on Adani Power at 2 times the valuation of NTPCs? To me, notwithstanding the company's favorable run in the markets in recent months, the fundamentals of Adani Power appear extremely risky. In fact, even as per credit rating agencies, the Adani Group as a whole, which has been on a rapid diversification spree, expanding its empire centered on ports and coal mining to include airports, data centers, and even wants to get into cement and green energy. It has even pledged to plow in $70 billion into renewable projects. It stands extremely leveraged. So beware of the bubble that stocks like Adani Power have shown with their unrealistic surge in recent months. And do not get complacent holding on to stocks which are highly vulnerable in a market crash. Hope you like this video. Stay tuned for more such videos on the safest and most appealing permanent wealth creating stocks. Thank you. Thanks for watching.